Welcome into the reaction channel, folks. Got a whole bunch of stuff to get into here today, okay? Got some videos I want to react to in this one, some little clips. First one up here, the Fed is taking on risks they don't have to, says the professor, Jeremy Siegel. The moral of that story is the Fed's taking too much risk by not lowering rates. We'll react to what Jeremy Siegel says here, and that's going to set up for a market crash, a big recession, those sorts of things, right? The key to a soft landing is a Fed getting off data dependence, says Tom Lee. He went on CNBC, spoke about a few different subjects. We'll react to that one. I want to react to this one. Don't think we're getting a recession over the next 12 months, says this gentleman from T. Rowe Price. NVIDIA will surprise the upside. That's going to be huge news next week. Big earnings coming for NVIDIA. We'll speak about that, how that one sets up here into essentially these earnings. Do I believe it's going to do well in these earnings, not well, those sorts of things. Trade Tracker, Stephanie Link trims Apple. I love listening to folks when they justify selling a stock in any sort of way. It's something I always appreciate, so we'll cover that. At the first here, we're just going to kind of react to some things that happen in the market that I think are important to take a look at. Okay, by the way, appreciate y'all joining me as always. Thank you so much for being here. Thank you for being subscribed to the channel. We're on the path to 50,000 subscribers on this channel. Appreciate y'all being here. Pin comment down there today if you're looking to apply to join 1000X, join my private stock group, the wealth group, all those sorts of things. I'll put that as the pinned comment down there today. You can click on that, fill out an application if you're looking to join us there and take your game to a higher level. So Zoom stock, big move up here today. This is a stock I bought here recently. I never thought I would ever own Zoom stock, but yeah, over the past month or two, I actually started adding some shares of Zoom. And the reason being is the valuation on the stock is just incredibly attractive. You know what's interesting? A big investor, a big famous investor just sold this stock. This individual held a ton of shares of Zoom stock, and they just recently sold and took a ridiculous loss on this. This used to be one of their biggest investments for many years, and they just got out of this baby. Do you know who it is? Cathie Wood. Cathie Wood just got out of this baby. I mean, look at what she holds now and try to find Zoom in there. And this was a huge position for her for the longest time. She obviously was buying this back in the day when the stock was going to the moon, right? And she gets out of it here recently, and now the stock bottoms and starts going up. I mean, this is the first time we've seen Zoom stock explode higher on earnings in how long? Like, seriously, I might have to go back to like 2020, 21 days to see a stock exploding the upside. Stock's up almost 13%. You can't make this stuff up. Absolutely incredible. But let me just be very clear. Zoom, the thing that's made this stock so attractive is the stability in the business model, the income statement and the balance sheet's top tier. And then you attract that with a valuation here, right? And it's a hard stock not to, be at least somewhat interested in it. It's not the most exciting stock, certainly by any means, in the stock market, but is it a moneymaker over this next few years? It should be. The business model is incredibly sticky, and we're seeing this now at that point in time, right? So great move for that one. Avant made a big move up here today, 9%. The Planet made a big move up here today, 8%. Those are the sorts of stocks you really want to see doing well if you want to believe the market is in the earlier stages of a bull market, right? Those are stocks you want to see doing well because you've got to see everything doing well. The issue we really had for, let's call it 2023 going into the first half of this year, 2024, the issue we had was it was just the top of the market. And it's only big tech doing well and nothing else does well, right? Real bull markets don't act like that. Real bull markets, you see everything starting to participate. Small caps, even micro caps, right? The top of the market, everything does well. That's a real bull market. And so a lot of people haven't, for the past year and a half, they haven't really given this market enough credit because they're looking and they're like, it's 10, 15 of the biggest stocks that are really driving all the gains. Where's everything else at? How can you call this a bull market, right? That's fair. That's fair. But when you start to see these sorts of stocks start to perform, if those ones keep performing over this next several months, then you're in full-scale bull market at that point in time because then just everything's participating, right? So even stocks like a PayPal green again here today. This was one of those days you thought maybe, given that PayPal's been so strong, given that today was a rough day for many stocks out there in the market, some of these bigger stocks, you would have thought this was a day like PayPal's got to close red. And the fact that it's still finished green today definitely shows you a lot of bullish momentum in regards to PayPal here today. Tesla, big downward move here, 5% plus. I did also hear after the bell, Uber is going to be partnering with, I believe, Cruise from GM. So we'll see kind of where all that shakes out. But that's not why the stock is down 5% here today. Honest made a downward move. That stock's been red hot. So that, it's kind of natural. It had to make a move down. Shopify red today. Amazon red. Amazon's definitely an opportunity in this market. Palantir's been red hot. That one finally showed a little weakness out there. If we look at commodities, take a peek at this. So GSG up slightly here today, but look at the downtrend this baby's been on. I love it, man. I love it. On a 1 year, GSG down about 2%. We're still looking really good. Now, if the Fed starts cutting, okay, we could end up in a problem here, okay? Let me describe a problem to you guys. It's always my job to get you guys mentally prepared for things that haven't transpired but could, right? Before everybody starts talking about it, because by the time everybody starts talking about it, it's too late. So, we do have a potential problem here. When the Federal Reserve starts cutting rates, we could see a phenomenon where commodities start a major upcycle. It's not a guarantee, but it's a serious potential. And specifically things like oil. Now, if the Fed starts cutting, oil starts going up substantially, it's going to lead to inflation fears, right? And the further oil was to go up, or commodities in general, the more it would lead to more and more inflation fears for really, let's call it 2025, 2026. Which would then potentially put the Fed in a situation where they couldn't lower as quickly, right? It also then leads into a problem of inflation and hitting the consumer again. So it is a risk factor. It's a risk factor we have to account for. We have to take that serious, and it is a potential. And you actually did see that prior to the great financial crisis. The Fed started lowering rates in, I think it was September 2007, if I recall, right? It was definitely later in 2007. I think it was around September 2007, which is kind of scary. And then what happened after that, commodities went through a very big kind of bull cycle there, and that helped push the consumer even more into recession. The Fed didn't lower rates probably nearly as fast as they could have, right? Because commodities were starting to run huge, oil was starting to run huge, and then what ended up happening was a great financial crisis, right? So that's something we got to be aware of. It's a serious risk. I mean, when you're starting to go through a cut cycle, you're playing a high stakes game, man. You're playing a high stakes game. And that's what we're going into now at this point in time. Take a look at Bitcoin here today. Bitcoin chilling out about 60,000 on that one. I mean, ideally we'd want to see Bitcoin start to perform better here. If we're really talking about going into a more bullish market, Bitcoin just hasn't been doing a dang thing for six months now. You go back to March, Bitcoin's, 70,000 plus here, right? And, here we are, 60,000. It's just, you're not seeing the momentum in Bitcoin that you really want to see if we're in kind of a more risk-on period in regards to the financial markets in general. So we'll see kind of what happens there. If we look at my possible buys watch list here today, ooh, I like that move for Celsius there. I think I got to start a position in Celsius soon. The tough thing for me is there's so many stocks that I believe are a buy right now. But I think I do have to start a position in Celsius. The more I've looked into the company, studied the company, the financials, the product, the more I'm convinced. I mean, it is crazy. Every single time, basically, I go to Target. And I like to see the Celsius section at Target, right? And I've been doing store walks at Sam's Club, Costco. You may think, why put in all that time for a stock you don't even have a penny invested in yet? You got to do the work early to make sure it's the one, right? And then we can go from there. So it's fascinating. Every single time I go to Target to go check out the Celsius section, it's fascinating. Somebody buys Celsius right in front of me. Literally, they grab it off the shelf. It's geez, how well does this stuff really sell? It's just incredible to me. Every single time I'll go to that section, within 10 seconds of me being there, somebody comes and buys a few cans of Celsius. It almost never fails. And so, anyways, Celsius, I'm going to have to start something here soon in regards to this one. And just an epic downtrend here. And it's going to have to be sooner rather than later. Now, ooh, I just kind of played a game out a little bit in my brain. Here we go, okay? So, Celsius, if we back this up, this is a 1 year chart for Celsius. Stock's down 33%. Now, listen, if you bought Celsius stock in the past 1 year, you've lost money. Let's just call it what it is, right? And you probably lost a lot of money. But has this been a losing year for the market? No. So there's a good probability a lot of investors have made money other places in the market this year, right? Which Then when we start coming to the fourth quarter of this year, people start looking at their portfolios and they say, okay, I need to offset some of these gains I've sold for this year. So let's say you're a fund manager, you have $17 million of gains this year, and let's say you're sitting on Celsius stocks, a stock you hold, and you're sitting on a $1.7 million loss, and you're like, I got 17 million gains, 1.7 million in loss here in Celsius. You know what? Let me go ahead, sell out of this, so then I only have 15.3 in capital gains this year, right? Or if you're playing the short-term gain, the short-term gains or losses, and you can go ahead and write that off against that 17. So now you're at 15.3 you have to pay taxes on rather than 17. And then you say, you know what, I'll buy Celsius back in the first quarter of this year or the second quarter or something like that, right? So you could get into that situation in regards to Celsius where you do actually have some pretty decent tax loss harvesting. And remember, that doesn't just happen for big fund managers that might be running hundreds of millions of dollars or billions of dollars. It can also happen to retail investors, right? A lot of retail investors own Celsius. A lot of retail investors have probably made money on Meta and Nvidia and other stocks out there. Maybe they've taken some profits. And then they look at a Celsius and they're like, the stock's not doing anything, right? They're not convinced it's going to come back necessarily in the short term. They start thinking, you know what? I don't want to pay all this taxes to the government. Let me go ahead, take a loss on Celsius here, sell out. If I like the company and the numbers get better, I'll buy back in a few months from now, right? After that window is closed, that gap essentially in which you can't buy the stock back, or you then kind of get the same tax basis back. So this is very much a possibility that people should be aware of when you got a stock that went through an insane downtrend like Celsius, right? It's not like its stock went down a little bit. It's like the stock crashed, literally. Like that's the definition of a stock crash is what we're seeing in front of us right there. And so, yeah, that's something you got to take into account, and not just in the Celsius stock, but in the future on any stock that goes through a crash. Another great example of that, you want another great example of a stock that's probably going to face a lot of tax loss harvesting this year? It's right down here. Estee Lauder. Look at this stock. It's gotten destroyed. The definition of a stock crash, right? I mean, this stock was 157 just back in March. It's 91 bucks here today. So if we're looking at another stock that's probably going to see tax loss harvesting into year end, it's EL. It's right in front of you right there, right? It's another great example of a stock. You want another example of a stock that's probably going to face tax loss harvesting in that fourth quarter this year? Right here, Lululemon. So this is one of those stocks that even if it comes back here in the short term, don't be surprised if in the fourth quarter it gives back those gains because people tax loss harvest on that baby, right? Any stock that's crashed, you face that problem in the fourth quarter. I've seen it time and time again. Time and time again. So little food for thought in regards to that one. Now, strong stocks, a lot of times into year end, they just keep performing strong. And the reason being is, let's say you own Honest. One, you might like Honest for the fundamental story and everything that's going on there over the next few years. But additionally, if you've made a ton of money, why would you want to sell Honest? When you're like, oh, now I have to pay a ton of taxes on this? Let's say you bought it and you've held it for less than a year. Do you want to pay your normal tax rate of 30%, 28%? 35%, or would you rather hold it for a year and then pay 15% capital gains tax rate? I mean, I would rather pay 15%, right? It just is a lot more intelligent of a decision to pay 15%. So then you're like, I would rather just hold this for a year, right? And then we can see if I want out of it at that particular time, right? Or you could sell it in January, February, March, and then say, you know what, made a lot of money on this stock, it's treating me very well. I don't want to hold it for the next 2, 3, 4, 5, 6 years. I want to take my profit, but then you have a lot of time before you have to actually pay your taxes, right? Which are due in March, April of the following year. So, a lot of people play these tax games toward the fourth quarter of a year, and you got to understand, that it's something that plays out and it can hurt stocks. Now, a stock like Fubo, that's going to be a confusing one. I think, because we're in a massive uptrend, so I don't know if a stock like that will really see tax loss harvesting in the fourth quarter, just for the mere fact that it's in such a crazy uptrend. It'll probably continue to be an uptrend for the foreseeable future here. So I just don't know if people will, because it's going up so rapidly, so fast, I don't know if people will want to even bother tax loss harvesting because they'll be like, you might miss another 30, 40, 50% upside in the stock in a very short amount of time between the time you sell and then hope to buy back. So a stock like that, I don't know. And plus, a stock like that doesn't have nearly as much Wall Street money on it. The market cap's very small for that one there. If we go ahead and take a peek at, I want to see big tech here today. Big tech. So, oh my gosh, snowflake. Whoa. I didn't know snow got hit that hard. 15%? Oh my gosh. Oh my gosh. Wow. And, you know, the risk I've always stated in regards to Snowflake for you guys, right? Because I've always, you know, it's always been a talked about stock. What have I always told you guys in regards to Snowflake? You got to watch out with Snowflake. And why? There's one reason why, one main reason. It's because of the valuation of this company. A stock like this, as soon as you don't quite hit those growth rates investors are looking for, your stock is freaking done. When you trade at a forward P of 100 plus, a 2-year out forward P of 100 plus, I'm just telling you, man, as soon as you don't hit a growth rate, they're going to wreck your stock. And people think Palantir has a high valuation. That's a crazy thing. So let's go on 1000X here. Let's click the compare feature and compare Snow side by side with Palantir. You know, look at Palantir looks cheap next to Snow. And now we're at this point in time where people are starting to think Palantir might start outgrowing Snow. 2 years ago, 3 years ago, this wasn't even thought as possible. Like, especially 2 years ago. We went back 2 years ago. Snowflake's growth rates were so ridiculous. Palantir was going through a really tough time in their business 2 years ago. And a lot of people thought this could never happen. Now there's a real debate if Palantir is going to be able to outgrow Snowflake, which is incredible, right? Absolutely incredible. And you're looking, and Palantir is a far cheaper stock, and it looks like, honestly, their business model is positioned arguably even better than Snowflake, which is crazy to think. And so that's a risk in regards to Snowflake that I've always called out for you guys. And sure enough, we're seeing that show up. At some point in time, maybe Snowflake's a buy. But am I ready to step in right now? No, but man, what a fall. What a fall for this stock. If we go back to kind of February, the stock was pushing well over 200, over 230. Jeez. Oh my gosh. So on a 1 year, it's down 24%. Year to date, it's down 39%. 6 month is down 48%. Jeez. A 3 month is down about 30%. Incredible. And since IPO, it's now extremely negative since IPO. That's incredible to think, right? So since IPO, the stock is now down 52%. It went public at too high of a valuation. That's a bottom line. It went public at way too high of a valuation. People love Frank Slootman. People love, you know, Snowflake's growth rates. But dang, man, it's just the valuation was too pushed on that stock. And it's led to a horrible stock performance since it went IPO. Horrible, right? And you look at Palantir, a stock that gets comped against them a lot, which I don't think is right, but it is what it is. Here, I'll just pull it up for you guys here. If we go ahead and take a look at Palantir, so that stock since IPO looks pretty dang good, right? And I mean, this uptrend is incredible. So that's where the study of the business model comes through, right? And you know, if you weren't really studying the business models and all you were looking at as the financials, you got down the wrong path, right? And that could lead to some big losses there. Jeez, insane. And I don't even know if the pain's over in regards to Snow. Like, they're going through all this pain. Here's the difference, okay? When Palantir stock was getting destroyed back in 2022, what was simultaneously happening? The NASDAQ was also getting destroyed, right? And so it wasn't just Palantir was the only company feeling pain. No, I mean, Shopify fell like peak to trough 80%. Meta fell over 70%. Like, the pain was ridiculous, anything tech related. So Palantir was going through a ton of pain in a time where the market was going through a ton of pain. Tech stocks were going through a ton of pain. Snowflake, on the other hand, is going through a ton of pain, and the rest of tech is not. Tech's doing very well, and yet Snowflake is just down and down and down and down and down. That's a really bad sign. Because then you got to say, what if we got into a market? What if we got some sort of big correction the next few months? That might not happen, by the way, but what if we did? And let's say the market goes down 10, 20%. Where's Snowflake trading at then? $75? $70? Like, that's what you got to start to consider. If they're performing this bad in a good market, what's going to happen if it's a bad market? Let's react to some videos.
To join us right now to talk about the data, the markets.
The Professor Jeremy Siegel.
Fed commentary, maybe what we're going to hear out of Jackson Hole. Jeremy Siegel, Professor Emeritus of Finance at the University of Pennsylvania's Wharton School of Business, also Chief Economist at Wisdom Tree. Good morning to you, sir.
Good morning.
So
Andrew.
what do you think of the jobless claims number? What do you think of this sort of larger, revision going back a year? Does it matter?
Let me try to explain where I have trouble with Fed policy. The Fed has stated that its long-term Fed funds rate is 2.8% when risks are balanced. Now, taking a look ahead 6 months, if I were to ask you, what's more likely, a flare-up of inflation or a weakening job market? Now, we got decent numbers certainly today, but between those two, I say it's balanced, maybe even more towards a weakening job market.
That's fair.
Well, then why are we at the most restrictive monetary policy in over half a century if we have almost a risk-balanced look going forward? Now, a lot of people came back to me when I was, really agitated a couple of weeks ago. They said,
and you wanted 50 basis points, and then you switched gears.
I wanted 50 basis. They said, it's not 2.8%. They put that down, but it's really much higher. The economy's doing well. It's 5.3 right now. Economy's doing pretty well. Maybe that neutral rate is 4.8%. So they only need really a couple of cuts to get to that particular level. Well, if the neutral rate for Fed funds is 4.8 instead of 5.3, then why is the 10-year bond at 3.8? If you go through history, normally the 10-year bond is about 100 or more basis points above the neutral Fed funds rate.
That's fair.
Which would put it at 5.8. Wow. Not at 3.8.
Right.
Something is sort of out of kilter here.
So what's the answer then? Meaning, what would you do?
I think the Fed is just moving way too slow. I think they're taking on risks they don't have to take. If they would move it down faster, now I know that, Steve said it's 25, 50, 25. I mean, if they go 50, 50, if they get back down towards that 3 rate, I actually think it's 3.5, a little bit higher than what they said. But the faster they get down, the lower the probability that they're going to have a recession and a significant slowdown in the economy.
Yeah. So we definitely see eye to eye, 50-50. That's what I've been saying. Do a 50 here in September, do another 50 in either November, December, and then call it a year. Take us down 100 basis points, put us to 4.25 to 4.5 Fed funds rate. Cool. And then let's see what happens next year. Do we see another spike up in commodities once the Fed starts cutting? Keep an eye on that, right? Let's see. And then we can play it how it goes. Okay, inflation's still chilling. Let's say jobs market, we're not quite liking the numbers. Okay, then we can lower another 25, 50 basis points toward the beginning of 2025 and kind of take things from there, right? The one thing I'm fearful of is they go too slow here at the beginning, and then they get in emergency cuts because let's say the economy weakens a lot more or something like that throughout 2025. The jobs market weakens a lot, and then all of a sudden they're in some sort of emergency. And next thing you know, they're doing 75 basis point cuts, right? It's not going to look good for the market. It's not going to look good for the economy. It's not going to look good for anything. It's going to freak people out. No different than what happened in 2022. When all of a sudden the Fed started having to do those 75 basis point raises, everybody flipped out, right? I mean, that's the type of stuff that freaks people out. You can get away with 25s and 50s, and people won't go that crazy. They're like, okay, the Fed's moving considerably in a direction, but it's not out of control. When you start going 75 basis points or more per cut or per raise, people get freaked out fast. And that's the stuff the market doesn't like. That's the stuff CEOs don't like. It's hard to plan when you're getting 75 basis point moves at a particular time or more. So do 250s here at the end of this year, and then let's see where the cards lay after that. I mean, even at 250s, you're at 4.25 to 4.5, right? And CPI's in the high 2s right now. You're good. You're good. If we had CPI in the 4s right now, then I'd be okay. We're a little concerned because then we're basically cutting to where we're at CPI. We're good, man.
That's basically, I would like them to explain one with risk nearly balanced why are they twice as high as they should be?
Okay, let me ask you a different question then. Given what you know, given what you want them to do and what you think that they may do, how are you thinking about buying or not equities in this market?
I think equities are, they're basically you're at 21 times forward earnings. S&P is within 1% of an all-time high. 21, I've often said 20 is equilibrium, so it's a little high. If you take out, the
21, can you do something for me?
Egg 7, you're at 17, 18. They look more attractive. I don't see the small and value stocks moving until the Fed moves. And maybe
No, sir. We're already seeing value stocks move. We're already seeing some of these small cap stocks move, right? We're already starting to see that over the past, I would say, 6 to 12 months in regards to some of these stocks. Some of these stocks are later in the game. They just started making their move really in the past month. Others have been making a move for 3, 6, 12 months now at this point in time. So I definitely disagree with him. Even the Russell, if we just want to look at the Russell 2000 as a whole, right? Look at the Russell's move since around October, November of last year. It's a substantial move to upside. Now, the Russell still has to play a lot of catch up to the S&P 500 and to the NASDAQ, which could be very, very exciting. I can tell you if you own a few small cap stocks. But yeah, the move has already started, in my opinion.
Convincingly, I think that Chair Powell is definitely going to open up.
It's not even my opinion. It's just factual, actually.
Tomorrow, in his speech, he will not specify how much it'll be. They still have 4 weeks of data coming. I certainly hope it's larger rather than smaller to get back to where I think that neutral.
That's what she said.
It is.
And then, Professor, we keep asking the same question, in part because the DNC convention just happened or is happening right now, and they are. The Republicans had their convention a couple of weeks ago. Do you think that the market is saying anything about which way the White House is going to go in November?
Well, I think that if the Dems get all 3 branches of the government, presidency, House, and Senate, then it's more likely that Senator Harris's tax plan, and we all know that all taxes need to be renegotiated on December 31st of 2025. Many of them are likely to be implemented. If the Republicans can hold either the House or more likely the Senate, and it looks like that could be very, very close.
Yeah, I mean, to assume the Dems are going to take everything? No, that's not happening in my opinion.
Then basically, Harris's plans, I wouldn't say are DOA, but they're much less likely. The government still needs to renegotiate everything at the end of next year. The composition of the Congress, as well as the presidency, is really important. I don't think the market is yet focused on a 28% potential corporate tax.
Yeah, I mean, my opinion is if Harris wins, I do believe that she's not going to be able to get very much done the first couple of years. Which, if you don't like her policies, by the way, you're going to be very happy with because you don't want her to get stuff done, right? And so that I think is going to be the more realistic situation. And at this point in time, do I think Harris is going to win? Yeah, I think if I had to put odds on it, I'd put like 52% probability she wins versus maybe 48%. For Trump now at this point in time. Whereas if we went back to a month ago, it was Trump in a landslide over Biden, but there's a huge, one side lost a lot of momentum. The other side went like straight up to the moon in regards to kind of their momentum there. So, yeah, but at the end of the day, if she wins, like she's not going to get crap done that first couple of years. She's going to get blocked left and right because I believe Republicans are going to do pretty well in other races, and so therefore I think it's going to make it very difficult for her to get anything done in those first at least 2 years of her presidency. Which, once again, if you don't like her policies, that's something you're gonna definitely be in favor of, right? Because if you don't like somebody's policies, you don't want them to have an easy path to be able to get stuff done, right? You want it to be challenging. The key to a soft landing is a Fed getting off data dependence. Okay. By the way, and that's a way Wall Street can help kind of or big money in general can help kind of fix things the way they want it to be fixed. So let's say you feel like a certain president's going to get in office, right? And you don't like that person's policies, and so you want to kind of block them from getting things done. you can donate massive amounts of money to help another candidate, get elected and run ridiculous amounts of ads for them, put together the best anti-ads for their opponent and things like that, and try to help win them the election the best way possible. So then that person can help kind of block. There's a lot of games that are played in politics that I don't think a lot of people quite realize, but there's a lot. The key to a soft landing is a Fed getting off data dependence, Tom Lee.
Managing partner of head of research at Fundstrat Global Advisors, as well as a CNBC contributor. A month ago when the VIX hit 50 and there were growth fears about the economy, did you ever waver? Did you have any nights where you didn't sleep as well?
There were 3 days of horror, as the market post FOMC all the way to that Tokyo Black Monday. It was gut-wrenching.
Was it? For you?
Yeah, yes. But we viewed this ultimately as being a growth scare, because we didn't think the U.S. was entering recession, which a lot of people thought after that jobs report. And I think people thought there was systematic risk because of what's going on with the yen. But markets showed a lot of resilience since then. I mean, the fact that we snapped back so sharply is showing you how strong this market is.
Still?
Yes.
The revisions yesterday, not on your radar. Should they be on investors' radar screen? I thought it might be a good thing if the job market was not as hot as people thought.
Yes, I think it is incrementally important because the FOMC minutes that came out yesterday as well showed the Fed staff saying this is a strong labor market. Well, that jobs report that came out Friday and the revisions that just came out show a lot of jobs disappeared. It's not as strong a market. And I think it gives more ammunition for the Fed to start a cutting cycle. Mm-hmm. And that's going to give a lot of life to the economy.
And to the markets.
And to the markets, especially cyclical stocks and small cap stocks.
I mean, it depends here, right? It depends on how much the Fed cuts, how fast they cut. In terms of giving life to the economy, let's be really crystal clear. If the Fed cuts 25 basis points, does that make any substantial difference in the economy? No. Does it make any substantial difference in corporate earnings? No. It does nothing. Do a 50-50, you do 100 basis points in a year end. Okay, now we're at least starting, right? Now still not, even 100 basis points still doesn't change the game. That's just like, okay, we're moving in the right direction. Now you drop 200 basis points, 300 basis points, then you could talk about really starting to positively affect the economy. And rather than putting the brakes on, you're putting the gas on a little bit. You cut down to 0, then you're full on gas at that point in time, right? But yeah, man, 25 basis points, they cut that. Or even if they cut 25 in the year end, like that's like nothing, man. That's nothing.
Tech's already done well. So normally you'd think lower multiples could or at least multiples don't need to stay where they are or contract with a high multiple tech stock. So
and Jerome Powell has the perfect excuse to cut 50. With the recent jobs data, with a massive revision of over 800,000, right? And he has a perfect excuse. Oh, obviously going into this, going into the rate hike cycle, we went way too slow. We started out with 25. We made a big mistake, right? We want to make sure we don't make that big mistake again when we're going to cut, which is why we're going to start out with 50 basis point cuts here. So as we begin this cut cycle, we're doing it a little more aggressively because we don't want to make the same mistake we already made on the other side. We didn't go up nearly as fast as we should have, right? Or as early as we should have. He's got multiple angles of a perfect excuse here to go 50 right off the bat.
But at least feel better about the valuations if rates came down.
Yes, that's right. I think tech is still in a good place because of AI, and NVIDIA should reinforce that. And it's not a demanding multiple. NVIDIA is maybe 28 times forward earnings, which is for one of the most important companies in the world. It's not a high multiple. So
28, sometimes these Tom Lee numbers, I don't know where he gets some of his data. I'm going to be honest with you guys. I don't know where Tom Lee gets some of his data. Because I listen to him say some of these things sometimes, and I look out there, and I'm like, that's not accurate. Like where's he judging his numbers off of? Sometimes he'll talk about, small cap stocks had a 10 PE, 10 forward P or something like that, and I'm like, what's he talking about? Like, that's not accurate. So I sometimes he says some of these things, and I'm like, it's just not accurate, even remotely. And say NVIDIA's at a 28, it doesn't look like that, right? And keep in mind, on 1000X, we're taking into account analysts' expectations on average. So if they were to hit a 28 here soon, they're going to need to be a mile ahead of where analysts are at. And keep in mind, analysts have gotten more and more bullish on NVIDIA over the past year. So to try to beat these numbers is going to get tougher and tougher. So, man, sometimes his numbers, I'm just like, where are you getting those, Tom Lee? Where are you getting them, man?
If tech is in a good place and then we get Fed cuts, I think it allows the overall market to expand.
Do we see an orderly easing cycle because the Fed doesn't feel like it needs to act intra? They have a meeting where they go 50 or whatever. You think they just 25 and then the next meeting 25, so only do 50 this year and then maybe continue next year? You think it'll be like that?
I think that a soft landing the probabilities are going up, and that's why this should be a benign cutting cycle, like good for markets. But I think the key is the Fed getting off data dependence, because data dependence is the reason they missed the inflation turn. And I think now they're missing the soft landing.
Rear view mirror. Is it possible that they're too restrictive right now and that the lag we don't know how powerful the lag effect of the higher...
Joe just totally missed an opportunity there. Did you hear what Tom Lee just said? Like, how did Joe miss this opportunity? Did you hear what Tom Lee just said?
I think now they're missing the soft landing.
Rear view mirror.
Now they're missing the soft landing. Tom Lee just said, quote, now they're missing the soft landing. You got to go back in and attack that right now if you're Joe. What do you mean they're missing the soft landing? So you think they're going to lower too slow here? You think they need to go 50, 75? You think you're not lowering fast enough? They should already been lowering? What do you mean by that? Like you can't just let, Joe, focus a little more on listening and not talking, dude.
They missed the inflation turn, and I think now they're missing the soft landing.
Rear view mirror. Is it possible that they're too restrictive right now and that the lag we don't know how powerful the lag effect of the higher rates could be, and they end up doing 50 or doing a couple of 50s? Is that possible?
I think futures markets are showing more than 2 cuts, so I think the Fed probably is a little behind the curve, and we know there is a recession in housing and durables and auto sales, so there was a lot of pain out there. So cutting more aggressively would actually make sense, at least from the market's perspective.
Where do you think, well, you're a market cap, but where do you think unemployment tops out? Do we get to 5? Do we go over 5% unemployment?
You know, a lot of it has to do with how the Fed communicates to CEOs, because a lot of companies are cautious, right? With monetary policy this tight and real rates this tight, it makes them reluctant to expand. And so the job market itself kind of hinges on what the Fed's doing. And yeah, it could, once the job market starts seeing unemployment rise, it could get bad.
I think Bitcoin's 60,000, give or take. Gold has been hitting new highs, obviously. I think we showed a chart. Kelly was trying to tell me she had been right
about the disconnect.
No, about gold being a bet. So we looked at it over the last 5 years, or I don't know how many years, but gold was up 90% and Bitcoin was up 13,000%.
Okay.
That was that we looked at. So, I mean, gold is moving, and it's moving not in a correlated fashion with risk on, whereas Bitcoin definitely looks like it's just a
Does that ever switch?
I think it can. I mean, Bitcoin is just sort of got 2 functions, right? Because it is a risk-on asset, but I think it's an important protection against systematic risk.
Do you ever want it to be correlated to gold?
I think Bitcoin is digital gold, so I think it's replacing gold over time.
So eventually it should act like gold, which means that it shouldn't have the kind of meteoric rise that we're talking about here.
Well, it depends on what the dollar does, because there could be a day that dollar could debase, and then you'd want to own a lot of Bitcoin or gold. But, I mean, to me, the fact that gold's rising is showing you there's still a lot of fear out there. I mean, I think gold is almost a measure of the bearish sentiment, and that's why I think stocks still have upside.
Can we talk politics for just 1 second? Do you have an election prediction as it relates to the market? Do you think the market do you think anything we're seeing in the markets has anything to do with what's going to happen in November?
Yes, to an extent. I think that the markets are believing Trump's probabilities of winning are stronger than the polls are showing. But I think when the market sort of becomes more convinced of that, I think you'll see cyclical stocks do better, small caps, Bitcoin do better?
I don't think so. I think, everybody always looks at the presidential elections. That's the big one, right? And that's always the focus. But the market could also be looking at it, and they could be saying, we're going to have a split House-Senate situation. Whoever's in office isn't really going to be able to get anything done, and so whatever's been going on is going to keep going on. There's going to be no major tax change and those sorts of things. That's another way the market could be looking at it. So I know everybody just focused on the presidential election, but there are elections outside of the presidential election that matter significantly to, if you're actually going to get anything done or not.
Because these are really clear policy differences. But yes, to me, I think over the last couple of days, to me, the market seems like it's betting on Trump's odds being better than the polls.
Okay. All right, Tom, thank you.
Thank you.
Yeah, worst case scenario for the market would be Dems take everything. Harris wins and Dems just take it across the board and then the market have a full meltdown at that point in time, because then we'd be talking about, oh my gosh, like they might actually do the 28% corporate tax rate 7 percentage points away. Then you need to lower the stock market by a minimum of 7 percentage points, like overnight essentially, right? And then if we talk about some of those other tax changes being more of a concern, which some of them, even if they took everything, they wouldn't get them through, like capital gains, like some of those now. But in terms of corporate tax rate going to 28, if Dems took everything across the board, yeah, that's a real possibility, and the market would flip over that.
And Chief Investment Officer of T. Rowe Price, where he oversees nearly $500 billion in assets for the firm. How has your view, Sebastian, and thanks.
I doubt the powers to be will let that happen. I doubt they'll let that happen.
For being here, your own set with us. How has your view changed at all with what we've seen the past 6 months? We all talk about what happened a month ago. The whole soft landing narrative was a little bit less certain, I think, but now we're back fine, and the Fed gets an A for how it's handled this?
Hasn't changed much. I don't think we're getting a recession over the next 12 months. I think for Jackson Hole, Powell's going to want to be boring. He does not want to rock the boat here. The markets are on a knife's edge with every data point, and you saw what happened with the Bank of Japan, like a mini earthquake. So that's what Powell wants to avoid. One thing he said at the last press conference caught my attention, and it speaks to how the market is behaving right now. He went out of his way to say, we're data dependent, but we're not data point dependent. And so I think as investors, we have to move away from just being on this knife's edge where every single data point moves markets. It's not really healthy, especially with valuations that high.
So at one point, the market thought we'd get, almost 200 basis points probably. Then we got down to maybe 50, 75. Where are we right now, and what's the right level?
Yeah, so we're down to 3 cuts before the end of the year, 75 basis points. That's roughly what's priced in.
And will that continue next year? How many next year?
It probably continues. This is important. It's a potential regime shift for investors. We're getting into a Fed cutting cycle. What does it mean historically for markets? I just ran a study of 12 cutting cycles spanning 70 years. Now, I have to say, this environment is a little bit different because usually the Fed cuts when things get bad and worse than they are right now. The Fed wants to cut right now just because real rates, the rate after the inflation is getting high. But again, we don't see a recession. All that being said, 12 Fed cutting cycles, bonds outperform cash 12 out of 12 by an average of 8%. So with this regime shift, I think one of the things we're looking at as investors is, all this cash on the sidelines, is it time to start moving some of it into at least a diversified bond portfolio?
Really? And what would that look like in terms of duration? What would be the best place to be, do you think?
Unemployment back in that 2007 time around where they cut was insanely low. It was around 4.5-ish, 4.7-ish percent. It was insanely low when they started cutting rates, right? And then we still had a complete disaster. So, you just can't bank on essentially the Fed starting to lower. It means great things. Like, unemployment's low right now, so that means it's going to stay low. Like, no, it's not really how it works.
Everywhere.
Right now we're actually short duration. But I think a diversified bond portfolio We're looking at to reduce that underweight duration. So I'll tell you how we're positioned right now and what we're looking at. We're positioned with a cash buffer and some credit because we don't expect a recession. Where we're potentially moving, especially if rates come back up, maybe a last hurrah for the 10-year in the 4.5–5% range, that would be a good point, a good entry point if you want to be tactical, to diversify the portfolio, extend the duration, go closer to a broadly diversified, say, Barclays aggregate index duration. I think that's an opportunity because, rates are higher. And here's another thing, Joe. Bonds, as you've seen over the last few weeks, have started to diversify stocks again. And I've done a lot of work on the stock-bond correlation. It's a bit of a wonky thing, right? But as markets start to worry less about inflation and more about growth scares and the risk of a recession, whatever the probability is, maybe 20, 25%, as markets start to focus on growth risk, bonds can diversify stocks again.
You said that in previous cycles that we've seen, bonds outperform cash by 8%.
By a lot, yeah.
Okay. How much do stocks outperform cash or bonds?
Yeah, so that's a great question. Like, the Fed usually starts cutting when things are pretty bad for the economy. So the equity risk premium, the amount.
It's just not true. I just ran you through the great financial crisis example, right? Unemployment was in the mid-4s. That's not bad. That's great. Like, unemployment in the mid-4s is great historically. And yet they started cutting, right? So look at the other example, the more recent one, when the Fed started cutting at the end of, 2018 going into 2019, right? Was the economy in a bad spot at the end of 2018 going into 2019? No, absolutely not. Economy was very strong. Overall, very strong, just to be quite frank. Very low unemployment. Real wages were in a decent spot. A lot of people had gotten some tax breaks. Obviously, the corporate tax rates had all gone through by that time. Like, I wouldn't say that was a bad time. And yet, the Fed started cutting. So this notion of, like, the Fed only cuts when things are bad, that's not true remotely. Look at the last several cutting cycles.
Which stocks beat bonds is quite compressed. It's down to 2.2% historically across these 12 cutting cycles. But I would differentiate this upcoming cutting cycle in that this is not really a growth scare. I mean, we're on a knife's edge and things could change. But this is not as bad a situation, and I don't expect a recession. So ultimately, this is a bit boring, but we're at neutral, fully invested between your stocks and your bonds. Stay close to your long-term risk tolerance. That's how I think you play this market. We are long the broadening, though, Joe. I think this level of concentration, if I look out 12 months, it's bound to broaden. Value stocks have quietly outperformed growth stocks by 8% since July 10th.
Well, it doesn't sound like you'd be an 80-20. It sounds like you would favor bonds equal to stocks. Just no, you don't like cash, but so
how I would position going into 2025 is be heavy your top 10, 15, 20 favorite stocks, right? Keep good amount of cash around. If you want to go heavy, 30% cash. If you want to go light, 10% cash into 2025. And then if you got big money, hedge in the fourth quarter of this year in case it happens, right? You never know. What if we're going to go into a Fed cut cycle where next thing you know, the economy completely falls off the rails. Next thing you know, unemployment's 5%, 6%, 7%. It can happen quick. You never know. And so just go in hedged. Who knows what happens, right? Hedge up maybe October, November. If market goes super risk on the next month, maybe even hedge up toward the end of September. And set yourself up. Whatever happens in 2025, let it be, right? That's fine. If the market goes nice risk on, your 10, 15, 20 stocks you own that you love are going to likely perform tremendous, right? If the market crashes, okay, those hedges should print money. Your cash is going to be looking really good because then you're going to be able to buy the dip heavily, right? That 10 to 30% you have in cash. And then let's say the market doesn't do a whole lot of anything. It doesn't really go up in any substantial way in 25, doesn't really go down in any substantial way. Well, if you've got really good companies, those companies should likely still perform very well, right? And then your cash should hold in there pretty decent because you should still be able to get in 2025 on cash in a high yield savings account or in treasuries. You still should be able to get 3 to 4%, which should outstrip inflation. So you're still looking good as far as that goes. The only risk is you might lose on your hedge if that didn't quite work out, right? But that's why when you hedge, small amount of money. It's kind of no different than when you invest in a spec stock. You put a small amount of money in. Very similar in regards to hedging. NVIDIA will surprise the upside. Let's get into this one.
Sees more upside for the space and is looking to buy a mega cap name he actually sold just in July. He's the founder of EMJ Capital. Joins me now. Welcome back. It's good to see you.
You too.
Well, you don't feel like being out of Amazon that long, I guess, right? That's the one you sold, and now you got your eye on it again. Why?
My favorite three, Scott, in the Mag 7 right now are Apple going into the iPhone upgrade cycle this fall. Then Meta, because they're at all-time highs. They're really the first poster child of somebody who's making money hand over fist from AI. And then, of course, NVIDIA, the godfather. But after that, it's Amazon. And I did sell out of it in July, but it's darn cheap on a 5-year basis. It's like trading at, all-time lows on a forward PE basis.
True.
Nothing really was wrong with the quarter that they just reported a couple of weeks ago. So I think they are definitely one that's on my radar, and I plan on adding probably in a few weeks as we start to get closer to the next tech earnings season.
Yeah, if people don't have an entree to their portfolio and you're looking to add an entree, you're looking to add that piece of steak, that chicken, that shrimp, that salmon, guess what? We got it right here, baby. Amazon over the next, I would say 12 months, definitely looks like a very attractive entree adder. Same thing with Meta.
Well, we can't get to the next tech earnings season before we get out of this one, and we still have to consider NVIDIA a week from today.
Yep.
How do you see that?
I mean, it's huge, obviously. It's the most important stock in the world right now. Yep. So, if they laid an egg, it would be a major problem for the whole market.
They're not gonna. I
don't think they will. I think they're going to surprise to the upside. If you look ahead at sort of what
Be careful, though. Be careful. Because the NVIDIA, the problem with NVIDIA, they have to do so insanely ridiculously great now. Because they've been doing so insanely ridiculously great. So now, even if they were to beat these numbers, right, and beat the guidance, they have to beat it by so much to make people say, oh my gosh, NVIDIA is so amazing, right? You're talking about the A+ student. And if they get anything less than an A+, people are looking and they're like, what's going on here? Why no A+, right? NVIDIA can't even come in with an A- now at this point in time.
Is counting on a go-forward basis. It's almost like this explosion of AI revenue that they've seen over the last year and a half, is going to just sort of dry up. And I just don't think that's the case. Eric Schmidt gave a talk at Stanford recently. It was sort of leaked a few days ago, and they took it down off of YouTube because he made some critical comments about the work culture of Google. But embedded within that talk, one of his throwaway lines was, in talking to Sam Altman, they said that together,
they shouldn't have took that down. What a bunch of freaking babies. Come on, man.
Both believe that each of the hyperscalers, plus the OpenAIs of the world, we're probably going to have to spend something like $300 billion in NVIDIA chips over the next few years, each. $300 billion each. So, NVIDIA could basically only supply those hyperscalers, and their order book is going to be full for the next 4 years. It's a massive, staggering amount of money that's sitting in front of them. And, God love the Broadcoms and the AMDs of the world, but, the vast majority, like more than 95% of that revenue is going to go to NVIDIA.
Well, I mean, how do you just talked about, obviously the money that NVIDIA makes is the money that the hyperscalers are spending. So at what point do you look at what the hyperscalers are spending and say, you know what, it might be a little longer for the ROI or the return on invested capital side of the story than I think we're willing to admit. How should we look at that?
Well, I think that the Meta is showing now that they are making a lot of money from this.
Sure.
And that's why their stock is mid 500s right now. So I'm starting to think that Zuckerberg was sort of leading us on several years ago when he was saying that he was spending all this money on Reality Labs and people panicked and sold the stock down to $80. I kind of think he was trying to throw off his competitors by just spending all this money on NVIDIA GPUs so he could get a head start of them. So he's
yes, 100%. And he's specifically stated that they have a lot of other AI expenses in regards to the metaverse line. So everybody looks at the metaverse line like, oh my gosh, look at the loss, is so big. They don't realize there's a lot of other spending that's non-really metaverse related in there. He said that before in conference calls.
Now, if you're sitting in the seat of Andy Jassy, or Microsoft or OpenAI, are you going to let, another one of these competitors just, take the lead?
That's why you got to listen to conference calls on 1000X, baby. We got them right here. So important. You're going to find out so much information on those conference calls that no one else has a clue, because most people, they don't want to spend the time listening to these dang conference calls. Let's just be honest, okay? They do not want to spend the time listening to conference calls, and it's very, very valuable.
Become the dominant, player in AI going forward. I just don't think you can do that. And you're only spending a minority in some cases, or just, certainly less than your annual free cash flow that these companies are generating. So you're not going to spend that money just like leaving it on the balance sheet, and you're not going to
100%. Yep. Well said. And so as far as NVIDIA goes, very high expectations. They got to come in, knock it out of the ballpark in regards to their revenue, EPS. They got triple beat, and they got to beat by quite a significant margin to kind of keep the momentum going here, which it's possible they do, but it gets more and more difficult each quarter.
Saying that the shipments for this quarter when it comes to the iPhone might be better than expected. Well, you're making a face.
I don't know. I mean, skeptical? It could be, but the stock is up 32% since May. So I was really aggressively buying this stock. I got to a 9% position in my portfolio ahead of the quarter, which was not easy to do. But I felt really confident about it because the expectations were so low. You had downgrades every day. You had numbers coming down every day. Negative commentary every single day. And so I beefed up the position from my 1% holding to 9%. And now I just think it's prudent to trim because it's up 32%. They did have a good quarter. The iPhone refresh cycle could be good. It may not be. It may be a little more delayed, might be muted in the beginning, and then AI, as it gets into more phones around the world.
No, people don't care about AI. It's going to be the biggest iPhone ever. That's all people care about. Like, I don't know how many times I got to tell people this. Like, they think like the consumer is a lot more intelligent than they really are. Listen, it's the biggest iPhone ever. And people are going to make a big deal about that. Oh my gosh, I get the biggest iPhone. It always does well, every single cycle.
But that might not be the next quarter event, in my opinion. And I think we all expect services to be strong. It will, about 14%. That's certainly positive. And I think they've done a really great job on margins. We talked about margins before. So adding it all up, I don't want to be negative. I'm 5%. My index is almost 7%. I just wanted to take some gains.
All right, so you don't want to be negative, but it sounds like you're a little bit skeptical. So I just want to read a little bit more from this note from Loop, by the way. The rest of the thesis here is that Apple's in a position to create itself as consumers' Gen AI base case.
I just wanted to take some gains is not an intelligent way to think about it. I mean, you got to look at it from more of a holistic standpoint of like, maybe the P is really high, right? Like, let's say you're like, you know what, I own a lot of Apple stock. I don't really like the forward P. It's really elevated on the stock. That could lead to potentially, not much performance to upside over the next couple of years. And I think there's some other opportunities. That's a fair point she could have made. But just to say, you know what, I wanted to take some gains. It was a certain. That's not like good reasons to sell stock, guys. Good reasons to sell stock is like the valuations got too pushed on the stock. I don't feel comfortable with it here. I was buying the stock when it was a 15 forward P. It's now a 30 plus. I feel like there's a great opportunity in this particular stock over the next few years. It's very undervalued. It reminds me of Apple when I was at like that's a good reason to sell stock. Bad reasons, it's a certain amount of waiting. It's done really good recently. It's up a lot. Like, no. Okay, that's not valid reasons to sell a stock. All right, guys, appreciate you joining me as always. Thank you so much for being here. If you're looking to get full access to 1000xstocks.com to get all these different things, including our valuation tools, our financial tools, our metrics, our education portion. Have you seen our education portion? Woo, it's second to none, baby. These are phenomenal, including how to value a growth stock. Oh, you gotta be flipping my flapjacks. Incredible. So if you want access to that, as well as my private group, private stock group, wealth group, pin comment down there today, click on that, fill out an application, and we'll see if we can get you access to everything maybe next week. All right, guys, much love and have a great day.